All right, well, if you hear my voice and you stepped away from your computer, this is your 1 minute warning, 1 minute warning as I read through the bios here of our last two speakers of the day to start heading towards back to your computer. So for the final session today, which will be an hour session, it's post-election 2020 tax planning strategies for hop growers. So certainly timely. Our speakers are David Bohl and Rachael Gieseke. And David is the Assurance Senior Manager for Moss Adams, and he has practiced public accounting since 2010. He provides assurance and consulting services to food processing and agricultural companies, as well as employee benefit plan sponsors. David's agriculture clients include tree fruit and nut growers, fresh fruit packing and marketing companies, and manufacturers and distributors. Rachael is a tax partner at Moss Adams and has been in public accounting since 2009. She provides tax, consulting, and planning services to clients in the food, agribusiness, and beverage industries. So with that, David and Rachael, I'll turn it over to you. And just one more final reminder to everyone, if you've got questions, feel free to put them in anytime in the Q&A so we can address them at the end or perhaps during the presentation if Rachael and David choose to do so. But with that, we'll get ready to listen to our final session.
Thanks, Jackie. Can you confirm you can hear me?
Yes.
Yes.
Great, thank you. Well, welcome everybody, and thank you for joining us on the last session of the day. As Jackie mentioned, my name is Rachael Gieseke, and I am a tax partner with Moss Adams. And presenting with me today is David Bohl. He's an Assurance Senior Manager. We're both coming to you from our homes in snowy Yakima, Washington today, although we'd much rather be with you in California. Next slide. Today we're going to cover a few different topics. To start, I will be reviewing some of President Biden's proposed tax law changes, as well as a review of some of the COVID-19 relief law and CARES Act tax provisions. And then David will be discussing IT security and giving an update on a couple gap standard changes. We apologize in advance if we move too quickly through the material. However, we have a lot to share. So please submit your questions in the Q&A and we'll do our best to address them today and follow up if we're not able to get to all of them. Next slide. To start today, we're going to review some of the tax law changes that now President Biden has proposed, changes to President Trump's tax law changes. So in order for these changes to go through, a few things had to happen. Biden first had to win the election, and then there needed to be a Democrat majority in the House and Senate. As we can see, the House majority sits with the Democrats and the Senate at 50-50 with the Vice President tiebreaker. So the Democrats do have the majority, but by a razor-thin margin. With this current state of Congress, there's been a lot of discussions about possible changes to tax law. Next slide. However, in a matter of 2 years, there are a number of Senate seats up for re-election. So this is a fluid process and the landscape today may change over time. Next slide. Now we're going to walk through a comparison of the few proposed changes against the current tax law. Just as a reminder, a lot of the current tax law went into effect at the beginning of 2018 under Trump's Tax Cuts and Jobs Acts. So some of the current law is still very new. And again, Biden, these proposals that we are discussing are just proposals. It's what was discussed during the campaign. So nothing is set in stone. And this is, again, fluid and likely to change over time. Next slide. As most have heard in the news, one of Biden's top hit items was the corporate tax rate. Currently, that rate is 21%. Biden's proposal is to increase that to 28% with a 15% minimum tax on large corporations with 100 million of annual book income. The goal here really is focusing on those large corporations with that minimum tax. Next is the qualified business income deduction, or QBI for short. The QBI deduction is a 20% deduction of pass-through income at the individual or trust level. This brings the effective tax rate on pass-through income down from 37% to 29.6%. Biden would like to see this deduction phased out for those earning more than $400,000. 400,000 seems to be a magic number for Biden, where he'd like to see the tax rates increase for individuals. There's been a lot of focus and attention on the corporate tax rate and even the individual tax rate increase. However, if you have significant pass-through income, this could be a huge change for you. 29.6% is 80% of the top 37% individual rate. So without this QBI deduction, that is a rate increase of 7%. Biden hasn't addressed any specific plans to eliminate the accelerated bonus depreciation, which is 100% expensing of qualified asset purchases during the year. Likely this will expire as it's set to expire starting in 2023. Next slide. Biden has proposed a 10% Made in America tax credit for companies that create jobs in America or increase wages. The goal here is really bring jobs back to the US. He's also suggested having a manufacturing community credit. There's very little detail out there on this credit, but it does give some insight to the administration's goals. Currently, the Work Opportunity Credit, or WOTC, is available for businesses that hire employees in certain classes of individuals. Those include military veterans, low-income individuals, those receiving government support. Biden would like to see that extended to also include military spouses. Next slide. The new market tax credit is available for those that hold an investment in low-income communities. This was set to expire at the end of 2020. However, it was extended as part of the extenders package to 2025. Biden would like to see this program expanded and made permanent. No surprise here, Biden would like to extend credits for solar, electric vehicles, and emissions reducing investments and limit fossil fuel subsidies. This next one has the potential of being a big deal, especially in real estate if this change were to gain traction. Biden would like to see the removal of the like-kind exchange deferral. Under tax reform, the like-kind exchange deferral for personal property was eliminated. However, it stayed in place for real estate. So if this were to go away, if someone sold property and wanted to reinvest those proceeds, they'd first have to pay tax on that gain. Unlike now, where if you sell real estate and you invest in like-kind property, you can do that with deferring the tax on that gain. So this will be a big deal in real estate and in investments, as this is a key planning tool. Biden would like to see the low-income housing tax credit extended, create a $15,000 tax credit for first-time home buyers, create a renter's tax credit for low-income families. Next, we're going to look at some of the individual tax provisions. As I mentioned earlier, there's been talk of an increase in the individual top tax rate, and Biden would like to see that increase back to 39.6% for those earning over $400,000. 39.6% was the top rate before tax reform under Trump. The next one has spurred a lot of discussion and a major topic with a lot of my clients. Biden has proposed removing the preferential tax rate for capital gains and qualified dividends for those earning over $1 million. So that tax, currently that preferential rate is at 20%. And so that would take that potentially to 39.6%, which is a significant increase for those with significant capital gains and qualified dividends. He would retain the 3.8% net investment income tax, or commonly referred to as the Obamacare tax, that is taxed on your passive income, again, capital gain type items. Biden has proposed some changes to itemized deductions. On the positive, he would like to see the cap of the state and local income taxes removed. That cap is at $10,000 and was part of tax reform. But then he'd also like to see an overall limitation of a 28% value on those itemized deductions for those in the highest tax rates. Estate taxes has been another significant area of discussion and should continue to be. Biden proposed eliminating the step-up in basis on assets inherited at death. This means if you die with an asset with a basis of $10 and a fair market value of $100, and your heirs were to immediately sell that property, they would pay tax on that $90 gain. Currently, if upon your passing, your heirs receive a step up in basis to that fair market value. So the fair market value and the basis would both be $100. And if they immediately sold that property, they would not have a gain. This is a significant planning, wealth transfer, and estate tool that is used. Currently, the lifetime exemption for estate taxes, meaning what you can transfer during life or upon death tax-free, is $11.58 million per person. Biden would like to see that reduced down to the 2009 or 2010 limits, which were $3.5 million and $5 million respectively. He'd also like to see a tax rate increase on the estate taxes. So the estate tax rate is currently 40%, and he'd like to see that increase to 45%. So there's a lot in the estate world that could be significant changes. And we really recommend that you're working with your advisors to understand your estate, understand the value, and have a plan in place in case there are changes that gain traction and you need to move quickly. Next slide. The Qualified Opportunity Fund is an incentive to defer capital gains with investments. What Biden doesn't like about this is he feels that there is more benefit to the businesses than the people living in those zones. So what he wants to do is reform this to have more of a focus on creating jobs and opportunities in those zones. He'd also like to see an increase in the child and dependent care credit with a larger portion available to be refunded and phased out for those earning over $400,000. Next slide. Student loans and education was a hot topic during the campaign. There's likely to be more information that comes out if these proposals do gain traction. Similar to the child and dependent care credit, he'd like to see an increase with a larger portion being refundable for the child tax credit. Next slide. This next provision is a payroll tax provision, and it's an interesting one, and we'll see where it goes. But the proposal is to change the limits on the FICA tax. So currently, the FICA tax, the 12.4%, has a limit of $137,700 of self-employed income or wages. So once you reach that $137,000 limit, you're no longer subject to that 12.4%. You're still subject to the 2.9% Medicare tax, but that 12.4% no longer. Biden would like to see that 12.4% FICA tax kick back in at wages over $400,000. So $137,000 to $400,000, you won't be paying the 12.4%, but potentially then at $400,000, that tax will kick back in. So those with substantial W-2 or self-employment income, this is another tax. This is another tax increase. There are planning opportunities here. So if this does gain momentum and it looks likely to pass, this will be a planning opportunity that you should be working with your advisors on. The retirement incentives, there's not a lot of detail out there on this or specifics, but really the goal here is to help small workers and caregivers with retirement planning. Next slide. Next, I'm going to go through some of the COVID-19 relief law. This is the COVID law that just came out. Next slide. The first major item is the PPP loans and the deductibility for tax purposes of those expenses. So when the PPP loans first came out, it was understood that Congress's intent was that when the loan was forgiven, that would not be considered taxable income. However, guidance was issued, and guidance was issued by the IRS that said, although the loan forgiveness won't be taxable income, the expenses you pay with those proceeds will not be tax deductible, which, if you do the math, makes that a taxable income item. So there was a lot of lobbying, a lot of discussion, and part of this COVID relief law, they finally came out and said, PPP loans are not taxable, the loan forgiveness is not going to be considered taxable income, and you can deduct those expenses paid with the proceeds for tax purposes. So this really got back to Congress's intent and was a welcome and needed clarification. Next slide. There is a second round of PPP funds available. I believe banks are taking applications currently. There were some changes from the first round. There was a decrease in the employee count, so 300 or fewer employees. And there's a revenue reduction requirement now that wasn't in the first round. So you have to experience a 25% or greater reduction in revenue in any quarter compared 2019 to 2020 or overall 2019 to 20. The loans are capped at $2 million. So any loans larger than that will not be qualified under this round 2. Next slide. The employer retention credit, just a couple changes. So this was part of the first round under the CARES Act. And it is a credit on wages paid to employees, qualified wages paid to employees. But under the CARES Act, it was limited to 50% of up to $10,000 of qualified wages. This is expanded it to 70%. So potentially a $14,000 per employee credit. And the other item that is big, that was a major change, is originally, if you received PPP funds, you could not qualify for this credit. So it was an either or, the credit or the PPP funds. They removed that, so now you can both receive the PPP funds and take advantage of this employer retention credit. Next slide. I'm going to go through some of the tax extenders. So this is typical at the end of each year that Congress extends tax provisions that were set to expire. So rather than making them permanent, they extend them 1 or 5 years. Typically, we wait for the year-end tax extenders bill to see what changes are going to occur. They did make a couple items permanent. The medical expense deduction floor. So if you expense your medical expenses when you itemize. Before there was a 10% floor, so 10% of your AGI, anything above that you could deduct. They've dropped that down to a 7.5% floor, so you should be able to deduct more of those medical expenses. And then they made the Section 179D, which is an energy efficient deduction for energy efficient improvements in commercial buildings, a permanent section. A couple items to note, there's now 100% deduction of business meals for 2021 and 2022, the calendar years. Before those were limited to 50%, and so now there's 100% deduction, including delivery and carry out. So definitely a push or a helpful deduction to support the restaurant businesses. And there was an extension of the paid sick leave and paid family leave through March 31st, 21. Next slide. These next 2 slides include a long list of tax extenders. I'm not going to go through each one item by item, but if you did take advantage or think that you could take advantage of any of these, this list has been extended through 2025. Next slide. Again, a list of tax extenders. These are extended through 2021. Next slide. Now I'm going to go over a few of the tax opportunities that were included in the CARES Act. The CARES Act was actually passed in last March, but there's several income tax provisions and benefits that were included that I want to make sure that we cover, at least at a high level, to ensure that you're able to take advantage or know of these. Next slide. The qualified improvement property technical correction. This is an interesting one. So this was actually a drafting error under the TCJA tax reform, and it made qualified improvement property 39-year assets, therefore not eligible for bonus depreciation, which was an unintended change. Qualified improvement property previously had been at 15 years and eligible for bonus. Because of political environment, they were not able to get the change made until the CARES Act came out, and they needed to make a change to help business owners. So now it is back to how it was intended, which is 15-year property and eligible for bonus. This was retroactive back to 2018. So if you had any of these additions in 2018 or 2019 and you didn't take advantage on your tax return, you can go back and take advantage now. Next slide. The changes to the net operating loss provisions, this was significant for a number of my clients that experienced losses in 2018 and 2019. So under tax reform, the net operating loss rules significantly changed. Generally for taxpayers, you were no longer able to carry back those net operating losses to previous years unless you were in farming and you were able to carry those back 2 years. So in 2018, if you had a farming loss, you could carry it back to 16 and recoup some of that tax paid in the previous year. In addition to not being able to carry back losses, anything that you were carrying forward had an 80% limitation put on it for use in the future. Under the CARES Act, as a way to get cash into business owners, especially those that had experienced losses, they relieved these limitations. So the net operating losses for 2018, 2019, and 2020 can be carried back 5 years. So if you look at 18, that's a carry back to 13 to recoup, again, some of those taxes paid in previous years. And they also removed the 80% limitation. So if it was more advantageous for you to carry a loss forward, you were able to take 100% advantage of that loss carry forward. So this was significant for a lot of folks. What is not included on this slide is also under tax reform, there was the excess business loss limitation rules. So you could offset $500,000 of business income, or sorry, $500,000 of other income with business losses, meaning wages or income from other sources that aren't business income. Under the CARES Act, they suspended those rules. So if you did have in 2018, let's say, an excess business loss limitation, you weren't able to utilize all your deductions, you could go back and amend your 2018 return, create a net operating loss that maybe you didn't have before, and then carry that loss back. So there were a couple different provisions to help adjust those losses and take advantage of those carryback rules. Next slide. There was also a payroll tax payment deferral. So you were able to defer the employer portion of Social Security, remitting that until the end of 2020. That does need to be paid back. It's not forgiveness, but it was just a deferral. So that needs to be paid back 50% at the end of 2021 and 50% at the end of 2022. So as a cash basis taxpayer, you're not able to deduct those payroll taxes in 2020 because you haven't paid for them, but you will be able to deduct 50% in 21 or in 2022 or whenever you pay them. Important here, though, is cash management, making sure you do have the cash available to pay by the due dates, because penalties for late payroll tax remittance are significant. Next slide. Also under tax reform, there was limitations put on how much interest expense you could deduct. So for ease of conversation, I think of it as EBITDA. So the limit was 30% of your EBITDA. Any interest expense over that, you could not deduct in the current year and had to be carried forward. Under the CARES Act, they increased that to 50%. So you're able to take more of your interest expense and decrease that limitation. So now it is a 50% calculation on your EBITDA. So that covers my tax slides as they relate to Biden's proposals and some of these COVID relief acts. I think now maybe would be a good time to pause to see if there's been any questions in the Q&A before David moves into his section on IT.
Okay, so I'm not seeing any questions coming in yet. If folks have any questions, normally you have to pay a lot for tax advice. So if anybody has any questions for Rachel, now is the time to ask.
We can also check the Q&A again after David speaks and go over any of them if anybody thinks of something to ask while David's presenting.
Sure, no, absolutely. Okay, we'll do that and keep everything moving then.
Great, we'll get going now. All right, so shifting gears a bit from the tax update to a cybersecurity update. So as is kind of the environment that we're in right now, cybersecurity is constantly a topic and will remain a topic of quite a bit of discussion into the future. Just recently in December, the SolarWinds attack that affected multiple government agencies as well as a large portion of the private sector, including companies such as Microsoft, really exposed just the ease in which companies can be subject to such attacks, and the vast array of tools that are used by attackers to perpetrate those attacks. So focus on some of those topics, different approaches that are used by attackers, as well as some strategies to defend yourself and recover. So just kind of to level set a little bit, the state of cybersecurity, and some of these stats are a couple years old, so they may have grown even more by now. But the average cost of a data breach to a U.S. company was almost $8 million as recently as 2018. And that was up from $5 million in 2015. So I would be surprised if that does not continue to rise. There are also about 5 billion, total records breached in 2018, and about $4 million is the average worldwide cost that a company pays as a result of a data breach. So that includes costs to recover within the company, or it might include credit monitoring services that are provided, or restitution to subjects that maybe have their information exposed during a breach. A total of 86% of companies have experienced at least one cyber incident in this annual report from 2017-2018. Again, that's a pretty consistent number, if not growing, over the past several years. So all of these stats continuing to trend upward. Some more recent trends have been related to crypto mining. As cryptocurrency becomes more and more prevalent, values of cryptocurrency increase. This will continue to become a major threat. Most malware is delivered by email. It's so prevalent these days in our business environment, and it's just an easy, low-cost entry point for many attackers. It also preys on one of the major weaknesses of businesses, which is the people element, which is something that you can't control 100% as an IT specialist or a chief security officer. So that's a threat that won't go away, and is constantly a source of frustration, and also a focus of education and training, and different strategies to try to prevent those attacks in the future. Targeted phishing attacks have been very prevalent as well. That's been a top security threat in recent years. That may be shifting a little bit more as a result of the crypto mining trend, but we'll still see that as a very prevalent attack method. And I'll get into more detail on some of these attack methods here in a few slides, but a lot of these attacks are now fileless, which means that they don't actually have to install new software or malware of any kind on your devices. So that's a shift that's becoming more prevalent as well. Ransomware is a big trend in recent years. That's becoming a big risk area, and it's been very prevalent in the agriculture industry as well. Companies are now identifying that you don't have to necessarily have sensitive data that is valuable to them. They know that that data is valuable to you, and then the attackers want to keep that data from you, and require you to pay a sum to, in theory, retrieve that data, which may or may not be possible in the end. But they don't really care if you have something that they can sell on the open market, as long as they know that locking you away from that data is valuable to you. Privacy regulations are one of the major drivers of spending for cybersecurity. So in the EU, you have the GDPR, and then the California Consumer Protection Act as well. That's one of the major focuses for how companies are driving their spend and their focus in cybersecurity, which is more along the lines of protecting the data that you have from being accessed publicly, and not necessarily with a focus on protecting the company and some more sensitive data that you may host internally. So diving in a little bit more in detail in some of the most common cyber attack methods, cryptojacking is one of the biggest trend areas. So this is using your computing devices to mine cryptocurrency. It doesn't require a download. It allows them to sneak a mining agent onto your computer, typically using email with a link that sends you to an unsuspecting website. And then you now have a process running on your computer that helps them mine cryptocurrency. It's not the same as crypto mining. Crypto mining is legal. That is an industry that is growing as investors look to accumulate cryptocurrency. Cryptojacking is the illegal cousin of crypto mining, in that they're using other people's computing power to do so. It's a difficult one to catch in some cases, because you won't necessarily see anything malicious. It won't necessarily be something that you're informed of, but you may notice decreases in your processing power and slowdown of your network. Ransomware, I talked about a little bit already. This one is becoming more and more prevalent. These two, cryptojacking and ransomware, battling for the top spot in as far as most occurrences. And in ransomware, hackers will gain access to your system. Typically, that involves some sort of phishing or entrance avenue that they gain access to your system and encrypt some of your sensitive data. They don't necessarily even have to take that data. They just prevent you from having it. And they'll hold that data hostage, which can be a severe interruption to business activities, usually requesting a sum of money. We've definitely seen some cases where companies have paid that sum of money and not really received their data back the way they would have expected. We've also seen some where companies had said, "Oh, no way, I'm not paying that," and relied on backups and found out that backups may have been affected by this, or backups may have been insufficient. So definitely a risk area that everyone should be aware of. Spear phishing is a twist on the common phishing that you've probably heard of via email. This is specifically looking for targeted data or someone who has that targeted data. where maybe bank account information or IT system access information. They're hoping that some human will reply or otherwise allow them access to that information and help them in gaining further access or otherwise accessing bank accounts or other sensitive areas. Whaling or CEO fraud, similar but targeted more at the C-level executives. So this is something that that can be a bigger, more exposed version of phishing or spear phishing. Internet of Things. This is one that hasn't really taken off as a prevalent attack method, though it's commonly referenced as one of the bigger risk areas in the future. So the Internet of Things refers primarily to smart home, smart office technology devices that may perform a single function, a low processing power. Think smart thermostats or even smart TVs or something along those lines that they generally lack security functions that you would see in higher performing computing devices. But as a result, they have this exposure because they don't have a security platform. A lot of times they don't have encryption or they don't have a security method. And if they do, it's using some benign default password that that can easily be hacked. And then fileless attacks, which has been growing more and more, as we saw in an earlier slide. This has become the more common type of attack versus installing a virus or other malware on a computer. This type of attack doesn't need to install anything malicious. It takes advantage of existing vulnerabilities in existing tools that are on the machines, and this isn't exclusive to one type of machine or another. But there are utilities within Windows or Apple iOS that they can use to change by just using a command line and then add malicious code into those processes in order to perpetrate one of the other attack methods. So why is this all important? Well, this timeline really helps illustrate why defense is your best bet with cybersecurity. On average, within 2 hours of their initial access, attackers will be able to compromise other computers on your network. So if they gain access via phishing attack from one user clicking a link in a malicious email, within 2 hours, they probably have access to another device on your network. Within about 4 hours, they've identified some of the most sensitive data on your network, and then within 8 hours of that, they've probably obtained that data. They've copied that data if that's what their goal is, or otherwise encrypted it and locked you out of it. What's dangerous here, that all happens within about 8 hours. Generally takes an average of about 78 days for organizations to detect that they've been breached. And this was from a FireEye report in 2019. You may have seen FireEye in the news lately. They were the cybersecurity agent that was employed by many government agencies as well as other private companies that helped identify the SolarWinds attack in December. They identified it because they were one of the companies that was subject to the attack. The SolarWinds attack had been embedded in otherwise normal-looking software updates that SolarWinds had been providing to its customers, and attackers had gotten into those updates and changed some of the code over time. And this had been going on over the course of at least months. It was a very slow rollout, and it took a long time for anybody to know that anything was wrong. And this helps illustrate that as well. And then containment. So within 78 days, you may know that you've been breached. On average, it takes another 70 days or so to contain that breach. So you've identified it, you then need to rectify that issue and contain that from spreading further or becoming even more of a business interruption issue. So how do we defend against these different types of attacks? So some common methods for defending against cryptojacking. Again, no one method is going to be your fail-safe option for 100% protection from any of these. They're best used in conjunction with each other. And obviously there is a cost benefit analysis involved in this, but these are the most common methods that can help prevent against these types of attacks. So one is making sure your server credentials are hardened. Use multi-factor authentication, just helping to ensure that nobody has access to your system to install that agent that's going to mine on behalf of another party. Keep up to date with system patches, and that on its own, that wouldn't have stopped the SolarWinds attack. So make sure that you're supplementing that with other methods. Scan for unauthorized programs. That's a very common one that'll help with a lot of these attacks. And then limiting browser extensions as a method to attack one of the more susceptible areas and help prevent some of these attacks via browser extensions that may be easily installed and unidentified. Phishing and whaling, this one's definitely a challenge for IT professionals. It's not something that you can just hire a firm to say, hey, protect me from this. There has to be some level of cooperation from the people within the organization. The best way to continue to do that is education and then regular testing of that end user community. You want to help identify what a phishing email looks like, what things to look for. Looking at the actual addresses that are coming from, identifying any suspicious emails and investigating. We commonly use mobile phones for email in many cases. That can be a challenge because a lot of times the full email address isn't shown in those email applications, and that adds another risk because you're not seeing exactly who's sending you that information or asking for that information. But in some cases, having some technical security controls with your email, screening out some of the risky emails that may be caught by anti-spam filters, that can be really helpful as well. And then two-factor authentication is a good catch in case that there is an issue with the phishing that does result in a user giving up information or giving up their own access to the system. The two-factor authentication will help prevent that from spreading further, or help prevent that access from actually integrating into your system. Defending against Internet of Things and botnet attacks. I mentioned that sometimes these have default passwords. Something as simple as admin is the username and admin is the password. So be careful with those and change those passwords as much as you can. There's a recommendation to harden these devices, so disable any unused functionality. If you have a smart device and you're not using it as a smart device, it might be a good idea to turn those smart features off, disconnect it from the internet, something like that. Remove protocols that aren't needed. Ensure the firmware updates regularly if you are connected to the internet. That'll at least get you the security patches that may come, though they may be limited. And then segment those devices from the corporate network. Ideally, you don't have those attached to the corporate network to limit the amount of data that can be accessed via those rather low security devices. Defending against fileless attacks. You can disable some of the unused Windows services. Most commonly, PowerShell and WMI are Windows utilities that are used for these attacks. Keeping up to date with system patches, disabling macros if they're not needed. They can help help prevent some of these unwanted scripts from running as part of these other programs that already are included on your system. And then keeping an eye on system logs, looking at system performance, help identify some of those spikes that may be occurring that that are unexplained by your actual usage. That can also help with the cryptojacking as well. Now we'll shift into kind of what best practices are and how to continually improve your IT environment by following the cybersecurity framework that that was published by the National Institute of Standards and Technology. And it really starts with identifying what assets you have that you need to protect, what types of data that you collect, where that's stored, how it moves through the network, what service providers have access to your data, and performing a risk assessment to identify threats and vulnerabilities to those assets and that data that you have. So identification of what comprises your network and what you really want to protect. Then the next step is moving into protection. You want to protect that through logical and physical access controls. I mean, security of your servers and your computer equipment, as well as application passwords, other firewalls and malware detection software. All can be usable in this part of the cycle. And then make sure you're segmenting parts of your network where you can and it makes sense. It's nice to have all of your networks integrated and speaking well with each other, but that does add a layer of vulnerability. Next is detect. So you've identified your data, you've set up your initial protections system. Now you want to run your detection monitoring systems, and this can be user access reviews, looking at segregation of duties to make sure that you have proper monitoring in different areas. Having processes like monitoring system performance in place, or looking for unidentified software that may be running on the systems or on your network, as well as using anti-malware systems that are available to help detect attacks that may have already gotten underway there. So what you can do at a base level, really look at changing default usernames and passwords. That's base level important. Those are going to be low-hanging fruit for attackers. That includes the Internet of Things devices. Keep your antivirus and system software up to date. Make sure you have antivirus software, anti-malware software. Routinely install system patches. I recommend testing those before installation, but make sure that those patches are installed and installed timely. They may contain important updates that protect you from attacks that are more prevalent at that time. The cybersecurity game is really a race between attackers and defenders that is ongoing. And as attackers come up with new methods, defenders are really trying quickly to put tools in place to help prevent those attack methods. I referenced the SolarWinds attack. FireEye recently released some tools to help companies identify if they were subject to that specific attack or a similar attack. So there's a process that they've helped put together and publicized for people. So that keeping up to date on what those software patches are and why they're being released, it's typically a good idea to get those installed timely. And then real-time monitoring services, looking at your system performance and different applications that are running on your system to identify unwanted use. some independent evaluation options. So these are things that can be done by others outside of the company that you can bring in a professional to look at these. These are things that we offer as well as others in the consulting space. But cybersecurity maturity evaluation can help identify key areas of risk quickly. That's going to look at, it's more narrow in scope than kind of a full risk assessment, but it'll look at what risk areas do you have, walk through that process of identifying your data and helping you establish what protections you have and what you could use to really protect those key areas. Network vulnerability testing. This is using good hackers, so to speak, to test the accessibility of your systems to external attacks. Penetration testing is the same concept, but really looking at your network and system weaknesses, identifying those, analyzing those via coordinated attack attempts. Social engineering assessment. This is something that you can do to help prepare your company and your employees for phishing attacks. Help educate. It's a way to run tests to see if you would be subject. You can run relatively harmless, but phishing emails that would not cause an issue as a test to see if employees fall victim to those. Something that organizations run pretty regularly and can be really helpful in identifying where your risk areas lie in social engineering and phishing. Disaster and recovery and continuity. Again, most companies have a good backup system in place, but a lot of times without having to use that backup system, you're really relying on something that you haven't used, and ensuring that would be usable in the case of a ransomware attack or something similar, even natural disasters where your data may become unavailable due to various inaccessible reasons, and ensuring that you have a continuity plan in place so that your business can continue despite losing access to some of your data or your network. And then application security, looking at some of the specific controls you have in place to prevent unwanted access to your applications on your network, and protecting the company from unwanted manipulation or access to that information. All right, and then finally wrapping up, shifting gears again from the IT security, cybersecurity focus, I do focus also a lot on financial statements, audits, reviews, compilations, and in that world, there are a couple of new accounting standards, relatively new accounting standards that are quite broad in scope that I wanted to touch on quickly. You may have heard of these recently if you are in a financial reporting space, but revenue recognition and leases are some of the two most talked about, are two of the most talked about standards that have been released in the last 10 years or so. Revenue recognition standard originally came out in 2014, and this established a new 5-step process to recognize revenue from contracts with customers. And this is a new framework that's now applicable across all industries. It replaced previous guidance that was more industry specific. You had guidance for software providers, you had guidance for construction, you had guidance for manufacturers. And this was a more unified approach that was based on the core principle of who has control of the good or service that's being provided, and when is that control transferred, in order to determine how revenue is recognized. Most privately held calendar year-end entities would have adopted this in 2019. However, in June 2020, the effective date for anybody who had not yet adopted, which would include most fiscal year-end companies outside of calendar years, as well as some calendar year ends that just had not yet issued their financial statements, that those effective dates were deferred by a year. And so we now have some companies that are looking forward at the next year and still need to go through this adoption process. So make sure that you're conforming with that standard. Also on the horizon, for private companies is leases. This has already been adopted by public companies, but was pushed a bit further a couple times recently, most recently with the June 2020, that same effective date change. That was pushed out into 2021 or 2022, depending on your year end. This is a major change to many financial statements, as all leases are now recorded on the balance sheet. And I have an asterisk next to all because that doesn't necessarily include leases that are more short-term in nature, true month-to-month leases, or immaterial leases. So something like a copier that's leased on a monthly basis, or maybe even an annual basis, may not qualify or may not need to be capitalized in this case. But there's less of a distinction between what was typically an operating lease and a capital lease, and all of those leases now are on the balance sheet via a right of use asset and a lease liability. It's important to note that with the straight vanilla lease agreement, those are one-to-one asset and liability at day one, but over the course of the lease, they may not be equal, and it typically will have an effect on any balance sheet ratios that are dependent on current liabilities, such as your working capital current ratio, in that current liabilities are going to include a portion of the lease liability that is due in the next year, but there's no current asset on the asset side of the balance sheet related to these leases, as the right of use asset is 100% long-term. So something to be looking at, preparing for. It's quite the accounting exercise to get ready for adoption of this standard. It helps to start with creating an inventory of what your leases are to identify what kind of impact this might have, but then this can also impact banking relationships and financial statement covenants. So make sure you're looking at this impact before the adoption year comes.
So David, we're just at about 5 minutes left, and there is currently one question. I don't know if we'll get more, but just letting you know, we've got about 5 minutes left.
Sure, thank you. So I see the question. So the question is, what's my take on cloud storage, such as Google Workgroups, in terms of protections from all of the attacks mentioned? So a lot of the cloud storage options that are out there have a lot of protections built into them. They are provided by technology companies that you would trust to be up to date in a lot of those areas, such as Google or Microsoft, but that doesn't mean they're safe. The SolarWinds attack in particular impacted Microsoft 365 cloud-based applications. So it's not necessarily a game changer to use cloud-based work groups or something similar, in that it adds a little bit of exposure because you're now hosting everything on the cloud versus on a local machine, but they are typically more monitored than in security protocols than they would be if you're using in-house security or your own methods.
Okay, just a reminder for the final few minutes, if there are any more questions, to put them in the chat. I feel like that was a lot of great information, maybe a lot to absorb for everyone at once. If there are no other questions, I do have a question for both Rachel and David. Consider, again, there's a lot of stuff that you guys went over today. Is there something that you think may not be on people's radar that really should be, that they should start working on on the topics that you guys talked about?
I guess I can go first. And on the topics I talked about, like I mentioned, those are proposals that have been discussed. So it is being aware and making sure that you have a plan in place and you're discussing this with your advisors ahead of time, because it's not clear if there was to be tax law change, how quickly that would go into effect and how much runway we would have to do some restructuring or put an estate plan in place. So I think it's just being proactive with knowing what is out there, knowing, you know, what's getting traction and how quickly, and making sure you're coordinating with your advisors to make sure you do have a plan in place should you need to do some adjusting on structuring or estate planning.
Yeah, and on the cybersecurity, I would just reiterate that your exposure is probably greater than you estimate, even if you have been following this very closely and you know, take the issue very seriously. It's so prevalent now that you're probably subject to attacks that you may not know about, and you know, taking the approach of I'll deal with it when it comes, or, you know, thinking that you have a strong defense system in place is probably not the best bet. You know, continually trying to strengthen that defense is your strongest deterrent to having a significant business interruption issue, or significant expense related to trying to recover some of that data. And then on the accounting side, I'd re-emphasize, you know, working on preparing for that lease standard adoption if you do have financial statements, and working with your accountant to make sure that you're prepared for that adoption, and you're accounting for everything appropriately in doing so.
Well, wonderful. Thank you both so much for your presentation today, and then for that information at the end as well. I wanted to just take the opportunity to remind everyone, since risk assessment was mentioned, that Hopgrowers of America did just recently add a risk assessment to Good Binds. So it looks like there's some information that can certainly be incorporated into that. But I wanted to say thank you again once more to today's platform supporter, the Idaho Hop Growers Commission. Thank you to the Idaho Hop Growers Commission for helping to make this year's convention possible. And again, thank you to all our speakers today and sponsors. Tomorrow we'll begin again at 8 a.m. And as I think David pointed out the other day, David Henze, yes, this is all in Pacific Standard Time. And we'll be kicking off with the merchant panel, which is always very highly attended. So if there's no other questions, it looks like there are not. Thank you to everyone for attending today, and we will see you all tomorrow.